Yesterday we did digital payments. Today we are going to do government budgeting. Now here are the handouts and notes. A government budget is an annual financial statement that outlines the government's estimated revenues and expenditures for the upcoming fiscal year. In India, this is referred to as the annual financial statement under Article 112 of the Constitution. The budget is a crucial instrument of a country's fiscal policy, reflecting its economic policy and priorities. So, we're discussing about annual financial statement under Article 112 of the Constitution. Budget, in simple possible terms, is allocation of funds. Yes, it takes into account the revenues and expenditures. Fiscal year is the financial year. Now let's look at components of a government budget. So there are two main components: revenue budget and capital budget. Revenue budget will have revenue receipts and expenditures. So receipts that neither create liability nor reduce financial assets of the government, non-redeemable, and are used for routine government functioning. So such as tax revenue, direct and indirect both, and non-tax revenue like fees, fines, dividends from public sector. All of these are part of revenue receipts. Next is revenue expenditure. This does not lead to creation of physical financial assets for the government. Examples include, again for the routine functioning, salaries, pensions of government employees, interest payments on debt, subsidies, and maintenance of government services. Now we are on to capital budget, long-term assets and liabilities of the government. So that will include capital receipts and capital expenditure. So these are the receipts that either create a liability or lead to a reduction in financial assets. They are non-recurring in nature. Examples include market borrowings, recovery of loans given to states or entities, and disinvestment receipts, selling government shares in public sector companies. Next is capital expenditure. Expenditure that creates a physical financial asset or reduces a liability. Now, these are infrastructure expenditures like roads, bridges, hospitals, loans to state governments, and repayment of debt. Now, let's look at types of budget. Balanced budget, where government receipts and government expenditures equal each other. Surplus budget, where revenue exceeds expenditure. Deficit budget, where expenditure exceeds revenue. Budgetary deficits. Revenue deficit, effective revenue deficit, and fiscal deficit. And primary. So revenue deficit is excess of total revenue expenditure over total revenue receipts. So that means government is not able to earn or generating enough revenue to cover their living costs. So expenditure has gone beyond receipts. Effective revenue deficit, new concept, part of the fiscal deficit that shows difference between revenue deficit and grants and aid for the creation of capital assets. Accounts for capital asset creation by state government using grants from central government. So here they're talking about difference between revenue deficit and grants and aid for the creation of capital assets. Next is fiscal deficit. Difference between total government's expenditure, government's total expenditure, and total receipts, excluding borrowings. It indicates total borrowing. Total borrowing is the ground of the government. Formula is total expenditure minus revenue receipts plus non capital receipts, all the receipts. That's fiscal deficit. Next is primary deficit. The fiscal deficit minus interest payments is called as primary deficit. Let's look at the questions. With reference to the Union government cuts the following statements, all expenditures incurred on the consolidated fund of India have to be put to the vote of the Parliament. The appropriation bill has to be passed by both Lok Sabha and Rajya Sabha before it can become a law. No, neither one, neither two. Let's understand. The question tests the fundamental process of the Indian budget. State budget incurred, all expenses incurred on the current fund of India have to be put to the vote of Parliament. Category of expenditure known as charged expenditure on the consolidated fund of India, which is not subject to vote. This includes salaries and allowances of the President, Speaker, Deputy Speaker, and Justice of the Supreme Court, among others. Those expenditures can be discussed but not voted upon in Parliament. Statement 2 is incorrect because the appropriation bill is a money bill. Under Article 110.4, money bills are only voted in the Lok Sabha. The Rajya Sabha can only discuss and suggest amendments which the Lok Sabha may or may not accept. The Rajya Sabha must return the bill within 14 days, after which it is deemed passed. A decrease in the tax to GDP ratio of a country indicates which of the following? A decrease in tax to GDP ratio. Slowing economic growth, less equitable distribution of national income. Both are correct. Let's have a look at the explanation. A decrease in the tax to GDP ratio means that the government's tax revenue is shrinking relative to the size of the economy. This can be a sign of a few things. Firstly, a slow economic growth rate often leads to lower taxation of the corporate profits, personal incomes, and consumption expenditure fall. Secondly, it can affect the less equitable distribution of national income. Let's go to the next one. Which one of the following is likely to be the most inflationary in its effect? creating new way to finance budget deficits is something which we have discussed so many times earlier. A vote on account is a special provision used by the Government of India with reference to this caste performance statements. A vote on account is put to the government only in the case of change of government. A vote on account deals with the expenditure part of the government budget. The vote on account is voted on by the Lok Sabha and the Rajya Sabha can only discuss it. Answer is vote on account deals with the expenditure part of the government budget. So two only. Now understanding the question completely. Vote on account is a temporary provision to allow the government to meet its essential expenditure needs for a limited period until the full budget is passed. First statement is wrong. Is a change of government. Now, this is typically used when the full budget cannot be passed before the new financial year begins. Two is correct. It only deals with government expenses with the budget. With the expenses side of the budget, allow the government to draw funds from the consolidated fund. Now, next one. With reference to the Constitution of India, consider the following statements. Comptroller and Auditor General submits audit report to the government in the Parliament and Comptroller of the General of the state government to the Parliament. No. Next. Which of the following is not the components of the revenue expenditure of the government of India? Revenue, expenditure. All three. Interest rates on loans, expenditure on subsidies, and the grants and for institutions. All three are part of the expenditure. India deficit financing is used for raising resources for so sorry for that. In India, deficit financing is used for raising resources for economic development. Yes, that's the right one. So that's all for today.